Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I'm Paul Winkler, Ira Work, Ann Swaski. So, there's a lot of stuff in the news. I don't know if you guys have been reading the news lately, but there's a lot of stuff in the news about finance.
Yes, there is.
There's just a ton of it. Oh, there's just talk about, did a couple of videos this week, and one of them was just talking about all the negative stuff out there and how people can get ahead of them. It was a fun video. I wasn't going to talk about it, but I'm going to talk about it for a second because it was a fun video. So the idea behind this video was one of the guys in the office here started talking about, he was reading something and I talking about a study and I go, I remember that study. Oh my goodness, that was a really cool study. But it was basically rats and people. And what they did is they set up two buttons, a green button and a red button. And the green button blinked more or turned on more often than the red button. It turned on 80% of the time. And the idea was to figure out which button you wanted to push. And, if you push the button that was the right button, you got a reward. Now, the rats got a piece of cheese. So rats dig cheese, so that was good for them. Then if the red button blinked on, that was... that was 20% of the time. You got a big piece of cheese if you guessed it right. But the problem was that it was random. You didn't know whether this thing was going to blink or whether the green was going to blink. And 80% of the blinks were the green button, 20% of the red one. So what they did was this. They had the rats going up against humans, and the rats kind of saw that the green one blinked a little bit more often than the red one. They figured it out. So what they did is they just always hit the green one every single time because they didn't know when the red one was going to blink. So they just hit it every single time, and they got a piece of cheese 80% of the time.
Makes sense.
The people, on the other hand, they thought they saw patterns. So they weren't going to be outsmarted by a rat. So what they did is every once in a while they would hit the red button. And hence, they lost more often than the rats did.
So they lost to rats.
What was their percentage?
Okay.
What was it?
What was their percentage of getting cheese? The rats were 80%.
80%.
No, that's the rats.
Go for cheese.
No, I'm saying, what was the percentage of the times the people got cheese?
It is interesting because it was a little over 50% because they kind of figured out that it was more often that the green light went on. But it was, I wanted to tell you it was 68%. It wasn't terrible, but it was less than the rats.
Okay, so 68%, 68% of the hitting of the button,
yeah.
The humans got the cheese, the ones with the brains.
They didn't get cheese, Ira.
Humans
didn't want the cheese. It wasn't going to do it.
Just follow this.
They got $1. I don't know.
All right, they got $1. All right, good.
Whatever.
Okay, they got $1. But the rats got cheese 80% of the time.
Yeah.
All right. That's like the stock market goes up 70% of the time.
Right. You're getting it.
But
yes.
the investors that try to do this on their own do not have success 70% of the time.
They screw up. They get lower returns because they're trying to find patterns.
Right.
Yeah.
And that was the whole point of the video. Yeah, exactly. That's why, I did this. I had that idea for a video because I thought this would be really good because this is what people try to do.
That'd be a great video.
Yeah. Well, I did it.
Oh, you did?
I did it.
I didn't see it
I just
yet.
haven't sent it to you.
Okay, yeah. Can't wait.
But it came out really good.
Yeah.
But it was, the whole idea being that it was just, this is kind of just interesting. This is what people do. And it's trying to figure out where it's going to go. And the funny part of it was that when they actually interviewed the people after this whole thing was over, what they found was that the people, even when they found out that it was completely random, swore that there was a pattern. Isn't that so typical of people, just looking for some kind of a pattern in things? So,
Well, and ego too, I think.
oh yeah,
I think ego factors in.
there is no question there is ego, no question whatsoever.
That reminds me of when my husband used to coach basketball.
Uh-huh.
3-pointers have about a 30% odd.
Okay,
if you have a good player.
Right.
So that's not that high.
So they got with a hot hand, they think
Right.
that you get a hot hand. I think I
Right.
know where you're going, right?
Yes.
Okay.
And the 2s have a very high percentage. So my husband
Right.
would always be telling his kids, go for the 2 because you can get the 2s a lot more often than you can these 3s when you're only getting maybe 30% of the time.
Right.
And yet the kids always wanted to do the 3.
There, there's drive for show, putt for dough, right?
It's human nature. Yeah.
It is human
Yeah.
nature. And oh man, what are you reminding me of? It was something I saw, and now I can't remember what the heck it was. It was trying to hit home runs all the time when really you don't want to try to do that. There was something I saw
Well,
this
that's
week.
actually the same principle. The home run hitters are maybe 250.
Right. It was like
yeah.
the Babe Ruth thing,
Right.
right?
Yeah.
Yeah.
A good
Ruth,
one would be a
he struck
250
out one
batting
time,
average,
but
yeah.
everybody remembers Babe Ruth
Exactly.
because of
Yeah.
the home runs,
Yeah.
right? So the thing that I thought was interesting this week, going through, I mean, good grief, some of the things out there. New York Times had an article. It was fascinating regarding inflation, and it was regarding Argentina.
Oh.
They said that you think 9% inflation is bad. Try 90% inflation, and to me, we know this about Argentina. We know about high inflation rates, but I was always wondering, how do these people cope? How do they do it?
And the Weimar Republic in Germany, same thing. You needed a
Sure.
wheelbarrow full of marks
Right,
to get
right,
bread.
right.
You
Yeah.
know, I don't know how they did it.
Well, that's why I had to read the article, and I went through this thing, and this guy, I started off with this guy was a real estate developer, and he had a pretty significant gift. He was able to figure out what $20 or $100 bills were actually fake. What were and using U.S. dollar bills, right?
Uh-huh.
He had an incredible gift at, just the feel of it. He knew what was counterfeit and what wasn't. But they basically were walking through how these people did it. And they said that this guy could buy houses and he would buy property, and it was all done with U.S. currency. They didn't use their own currency for this stuff. And they said that the Argentines hold so much U.S. currency. Now, this is a good money-making idea for all of you out there that are bored. They hold so much U.S. currency that they literally sometimes by mistake throw it out. If you go to a dump in Argentina, you may see U.S. dollar bills floating around in the wind.
Oh, my.
Isn't that funny?
Yeah.
So what these people do is, seriously, is they buy houses, land, cars, expensive art, all done with U.S. currency. And they said they expect that the inflation rate with the peso there is 64%. It's going to probably hit 90% by December, is what they're thinking. And they said that as countries all across the world try to cope with rising prices, perhaps no major economy that understands how to live with inflation better than Argentina. And it says that they had these residents running out to the grocery stores, and they're snatching up groceries before the people with the clerks with the price guns could get to them to increase the prices. I mean, they're just literally running around the stores, increasing prices every day. And this says one woman what she was doing is happily showing off her hiding spot for a wad of U.S. dollars. So that's partly how they're doing it. They're finding a currency that's stable, which is the U.S. dollar, and they're buying everything in U.S. dollars. And they found out that that what they've got to do is as soon as they get a peso, bam, as soon as they get one, they spend it. I mean, there's no sense in sitting on that thing. And that's the problem with inflation in general. You know, when we look at inflation and say, well, why is it a problem? Why do we worry about it? Why do we get concerned about it? Because inflation basically tells us that something is going to be way the heck more expensive next year or next week in Argentina. And what we got to do is whenever we get that money in our hot little hands, we go and spend it. And they don't put the money in the banks. They actually keep it at home. They don't even bother sticking it in the bank because there's no point. So what they're finding with these people, their wages are going up 50% per year in Argentina.
But that's not enough, is it?
No, it's not enough.
That's a crazy thing.
Well, it's the same thing here. Wages going up 3 or 4%, but inflation being 9%.
Yeah.
We're seeing the same thing.
Yeah.
Yeah, it is exactly what we're seeing. And that's interesting just to look at, you know, what's likely to happen. I've seen all kinds of conflicting stuff out there. It's just like, well, you know, you got oil prices coming down, so that's going to be anti-inflationary, and it's the political posturing with this inflation football is nothing short of just entertaining to watch, you know, for me. And I keep sitting there looking at long-term bonds. And, you know, I've been talking about that, you know, quite a bit over the past several months, that I'm looking at long-term bonds and I'm not seeing like really high interest rates on those long-term bonds, which leads me to think that maybe it's not going to be the longest lived thing in the world. But then you got the wild cards out there of China with Taiwan. You know, you got the computer chips right there. You got people going, hey, you know, what's going to happen with China and Taiwan? You know, are they going to go in there? And there was a really interesting piece about that, just talking about countries that are desperate and how, you know, when countries are desperate, you know, what they tend to do. And it makes me look at going, hey, you know, what companies are doing is self-preservation right now. You know, with the two companies that are moving into France with computer chip operations and the United States with computer chip operations, we're looking at basically pulling out and looking at going, hey, the writing may be on the wall that we're not going to be able to depend on Taiwan to actually come up with good semiconductors because of this garbage going on with China. And, you know, that, and then you've got Europe. I don't know if you guys saw this week with Europe. You know, the crazy thing going on with Europe right now? They have decided that it's really good to go back to coal.
Oh.
No joke. No joke. There is a run, and some countries that are coal-producing countries, and it was interesting, it wasn't the United States, wasn't one of the suppliers, but some of the countries that are producing coal have found a new really happy, excited customer. And that is European countries wanting to buy up coal because they're looking at the writing on the wall and going, we don't know when this Russia conflict is going to end. And they're saying, to heck with global warming. It's amazing how fast the whole worry about global warming can go sit on the sidelines. Is it not?
Well, maybe they're thinking that the United States will get cleaner so they can actually pollute more.
I don't know.
I'm just saying.
I don't know. I cease to try to figure out the logic of any of this stuff. I am giving up trying to figure out the logic of any of this garbage anymore. So that to me was interesting news. And then, of course, the housing prices. That has been fascinating news all week long. You know, looking at interest rates coming down a little bit with mortgages. But still, in all, if you look at just a couple of years ago or a year ago or so, the mortgage, a $300,000 mortgage, still, I did the math, about a year ago would have been about $1,200 per month. And it's over $1,700 still. And that is making a big difference regarding home sellers cutting prices as housing market is cooling.
Yeah, I've noticed a little bit more of that. I mean, Nashville is still a gret market, but it is slowing.
But Nashville is coming down.
Yeah, it is.
I've had one of my clients, I had dinner with and a very dear friend as well, basically said that she had 48 price drops in the last 2 weeks.
Wow.
Everywhere
Wow.
from Nashville down to Franklin.
Wow.
Well, that's
And
that
one-
pretty much
One of,
coincides
yeah,
with what I saw in the Wall Street
one
Journal.
of her clients was actually looking at paying $30,000 to help the other person buy down the interest rate of the mortgage. So the sellers are getting creative, the mortgage brokers are getting creative, but prices are coming
Right.
down.
Well, yeah, and some of the talk regarding mortgages. A matter of fact, maybe we'll talk a little bit about that, in a second. I think that would be an interesting topic, just because there are some good little pointers about mortgages that maybe we ought to share with you. So let's do this. Let's take a quick break and be right back after this. You're listening to the Investor Coaching Show. Paul Winkler, Ira Work, and Ann Sawaski. We will be back right after this. Okay, so why this week's big mortgage drop below 5% isn't what it seems. I mean, so if you look at what has been going on with interest rates, there has been a lot of parading of, hey, we've got an interest rate drop, things are looking a little bit better. As I said, even with the interest rate drop to what it is, it's still, you went from a mortgage payment on a $300,000 loan, 30-year loan, being $1,200 going, it's still over $1,700. So it's still a pretty big difference. But basically what happened is this roller coaster ride with mortgage interest rates comes on the heels of the Federal Reserve's decision to, at the end of July, to hike the benchmark rate on, but it was 75 basis points, it was 0.75%. And the reason that is a big deal is because people were thinking it might have been even higher than that. The concern was that we were going to have more inflation. If we have more inflation, then we're going to have to increase interest rates even further in the future. And these are the surprises that come out. You don't really know what's going to happen. Some of the issues with the employment numbers coming out, it wasn't quite as hot as a lot of people thought it was going to be, which basically led us to believe that we might not have to increase it as much. Because typically what you do is you increase the interest rate in order to slow down the economy and in order to slow down some of the employment cost growth. And then as a result, then you don't have to worry about so much inflation in the future. So that was really what was going on. Now, most of the time what happens, people think that, as the Fed rates go up, the mortgage interest rates follow suit. And to some extent it does happen. But remember that the Fed is more in control of the short-term interest rates. So it's not necessarily that predictable. You can't just sit there and go, hey, what's the Fed doing? Oh, that's what interest rates are going to do with mortgages. It doesn't work that way. But there was one guy that was interviewed for this one article on Time magazine. And he says, I don't rule out, below 5% interest rates over the next coming period of time. He says, I don't rule it out. He says, there's some signs the economy be slowing down. Bureau of Labor Statistics, they talked about the job openings and retail trade being hardest hit and cooling economy actually leading to lower interest rates. He says, but here's the thing: lower inflation could cause a drop in mortgage rates, and of course we see gas prices going down. We're seeing a little bit of a drop there, but you can't try to time the market. I think this is good advice. This is one of the things he said in this article. Don't try to time this, folks. This is not something you can really figure out. Because what happens is anytime you're looking at mortgage interest rates, you're looking at what people are willing to lend you money for 30 years. Now, if they knew for sure that interest rates were going to be higher in the future, they're not going to lend it to you at a lower interest rate. If they knew for certain there's going to be pressure for them to increase those interest rates because they don't want to get stuck with, loaning you money for 30 years if inflation's for certain going to be higher. That's just crazy. And on the other side, they would love to lend you money at a really high interest rate. But if inflation isn't going to be higher in the future, is going to be a little bit more slow as far as economic growth, they can't do it. They can't get you to borrow at those rates. So the markets are very efficient in that particular area as well. But, one of the things you can do is, let's say that somebody has gone and lent you money. and you go and lock in. And basically the idea being is that if you have an interest rate that you can afford on a house that you're looking at buying, it's a good idea to lock it in because you don't know if it's going to go up again in the future. And we don't have a crystal ball that works terribly well for telling us what future interest rates are going to be. And one of the things you can do when you go to a mortgage lender is you can actually go to them and say, hey, what if interest rates go down? Can I renegotiate this and bring it down? And if they say absolutely not, and there'll be some that won't do that, maybe you go someplace else. You can actually talk to somebody else.
Yeah, a lot of them do that. They'll let you drop it.
Yeah, and if the drop is more than 25 basis points, which is 0.25%, it might be something that you actually go and do. Mm-hmm. I mean, shoot, some of the smaller banks I've dealt with in the past, I've had this happen for me, where I dealt with smaller banks, especially on commercial loans. This is something that I actually experienced personally, where I was able to, they would come in and go, we're dropping your interest rate. And I was like, great, I like it. What do I have to sign? Nothing. We're dropping your interest rate.
Nice.
I mean, it was literally no paperwork.
Wow.
And because they knew that, Paul, being a financial guy, would probably pick up his toys and go someplace else if they didn't drop my interest rate. So, hence, sometimes you'll have some of that flexibility with smaller banks that you don't necessarily have with the larger banks. But that's one of the things to think about. Don't try to figure this out. Because, the minute you think you got it figured out, a curveball is thrown at you and interest rates, end up shooting up and with no end in sight. And then all of a sudden, then there's a huge demand for money because people think the interest rate's going to go even higher. That increases the demand for money. When you increase the demand for money, that increases the cost for money. And you can end up in a situation where you are just sunk, man. That's all there is to it. So anyway, mortgages, just look at it, keep an eye on it. People ask all the time, do you think 15-year mortgages? What do you guys typically, and when people ask you that, Ira, 15-year mortgages, 30-year mortgages, what?
I basically advise people to take a 30-year mortgage, take the extra money, max out their retirement account, or put as much into their retirement account because they're going to need the liquid assets to generate income in retirement. And then if they have extra money after they do max out, if they can max out, then put the money into the mortgage.
Pay extra, yeah.
Right.
Well, and we're not against having, I like the flexibility personally too.
Well, the other thing too is if you need money and all your money is tied up in your brick and mortar, your house, and now let's say you pay off your house, because I know there's people there that promote paying off all your mortgage before you actually save money.
I've heard that before, yes.
But now all of a sudden you need money for something, and interest rates are 7% or 8% to refinance or pull equity out of your house.
Right.
So now you paid off, like in my case, a mortgage that's 2.625%.
Right.
And I have to borrow money at 5, 6, 7%.
Yeah. When you make extra payments, just recognize that you're investing in real estate because to get that money back out, you either have to refinance or sell the house.
Right. Now, the other thing, too, is when let's say you have a 4% interest rate, because I know interest rates were at 5.3 and then it came down to 4.99, which on the $300,000 mortgage that you were talking about is a $57 difference. Okay. So that's how interest rates have come down. It's like, well, gas came down 50 cents. I'm still paying $1.50 more. Okay. So I would look at, I'm paying a 4% rate of return. I'm paying a 4% interest rate on my mortgage, but my portfolio averages 8. I still get to keep 4 and get the growth of the 4.
Right.
Over the time I'm paying off the mortgage.
And, the thing to think about in terms of this as well is the shorter your time horizon, you don't ever want to take any of this stuff and go, well, you always do it this way.
Right.
So, I always go and, think of it this is just in general. As you get older, You know, you might want to actually set yourself up so that you actually have the mortgage paid off when you're actually physically retiring. Now, for some cases, I've had other people go, you know, it's not going to happen, and I'm going to set it up so that I have half the mortgage paid off when they get to retirement.
Right.
Do a reverse when they retire, a reverse mortgage.
Well, and
know,
again,
so-
and that's a good point, because that's my general guidance.
Right.
But, you know, and then I have people that are, you know what, I just don't like that. I don't feel comfortable with that. And what I always tell people is this: there is no right or wrong way to do it. It's getting the education to make an educated decision,
Yes.
so that you can feel good about what you've done.
Yeah.
And confident for the remainder of the time in the house or the remainder of your time on life that your investments are working for you, not the guy who sold them to you.
Yeah, you got it. Good point.